Okay, good morning. So I want us to continue with where we left last time. So last time we looked at the taxation of companies. Previously, we looked at the taxation of employment income. So today, I want us to look at taxation of partnership. Now, from the introduction, we can say that a partnership is an association of two or more persons who carry on a business together with the aim of making a profit. That is to say, if there are other partnership, for example, marriage is a partnership, but it is not for profit making, then a partnership is not a separate legal entity from its partner, unlike companies. So you also find that when you look at the various forms of business, we look at the companies, we look at the partnership, we look at the sole proprietorship, we look at the joint venture and others. So in this particular case, partnership is not a separate legal entity from its partners. So for tax purposes, the partnership itself is not taxed. Instead, the profit or losses are distributed and taxed in the hands of individual partner. So the moment you are going to do the adjusted profit or loss for the partners, then we are going to distribute the partnership profit among the partner on the ratios that are indicated or that are given, and then that particular partnership income is the one which is taxed on individual partner. So we have some few legal provisions as per the Income Tax Act. We have section 3.1, the charge of tax, and it says, subject to and in accordance with this act, a tax to be known as income tax shall be charged for each year of income upon all the income of persons, whether resident or non-resident, which accrued in or was derived from Kenya. Subject to this act, income upon which tax is chargeable under this act is income in respect of gain and or profit from a business for whatever period of time carried on. And finally, section 3, the definition of person. For the purpose of section 3, a person does not include partnership. And this is now where we normally say that it is the partners who are taxed, not the partnership as an entity. So now let us see how we determine the partner's gain or profit. For the purpose of section 3.2a1, the gain or profit of a partner shall be the sum of 1. Remuneration payable to him by the partnership together with interest on capital so payable less interest on capital payable by him on the partnership, and his share of total income of partnership calculated after deducting the total of any remuneration and interest on capital payable to any partner by the partnership and adding any interest on capital payable by any partner to the partnership. So we have some expenses which are not allowable, and this is very unique to partnership. 1, remuneration to partner. This is not an allowable expense because partners are not employees. We have bonuses and commission paid to partners. We have interest on partners' capital, private or personal expense of partners, drawing of taxable good by partners, any other non-allowable item as per general business rule. So remember we said that expenses which are not wholly and inclusive used for business purposes are not allowable for tax purposes, but the specific ones for partners are as highlighted above. Then we have allowable expenses, for example, interest on drawing. So interest on drawing, these are deductible if included in the account, medical insurance or medical expenses for partners, and normal business expense. These are normally allowable. So let us see the steps in computing partners' income. So first, we start with the adjusted partnership income, and this is computed as follows. So we start with the reported profit or loss. Then we add back the disallowed expenses. So 1, we have depreciation. Second, we have salaries or remuneration to partners. We have interest on partners' capital. We have other non-allowable expenses. Then we need to less or deduct the allowable expenses. Interest on drawing is an honorable expense, medical, non-taxable income. Then finally we get the adjusted income or profit. Then the step 2, you need to allocate adjusted income to partners. So we have partner A, partner B, partner C, and total. So we have remuneration. So this is now we are trying to allocate the adjusted income to the partner. So we have the remuneration, interest on capital, bonus, less interest on drawing, share of residual profit. After you have allocated all this, then you get the share of the residual profit. So interest from partnership business, other income, taxable income, then the taxable income as per the individual partners is now taxed at a graduated scale. The pay as you earn rates as we all are aware. How to calculate the interest? So interest on capital payable to partner is equal to agreed rate times partnership capital balance at the end. Interest on drawing receivable from partner is equal to agreed rate times partner drawing balance at the end of the year. An example, we have net profit as per the account is this. Then we have salaries to partner. We have is that. Interest on partner's capital is this. Depreciation is this. Drawing by partner is that. Interest on drawing, medical insurance, non-allowable expense, capital allowance is that. Then you are required to compute adjusted partnership income for tax purpose. 2, prepare profit allocation schedule showing each partner's taxable income for the partnership. So here we start by computing the adjusted partnership income. So we start with the net profit as per the account that is given. Salaries to partner, this is not allowable, we add back. Interest on capital, we add back, it's not allowable. Depreciation, we add back. Non-allowable entertainment, we add back. Then you get the totals. Then less the allowable deduction. Interest on drawing, it's allowable. Medical, it's allowable. Capital allowance is allowable. Get the total deduction. And this is the adjusted partnership income. This is the adjusted partnership income that you can see there. Then from this one, we allocate. So allocation, we have two partners, Dr. Justin and Dr. Faith. So salaries, we allocate salaries, interest on capital. Then we have the share of the remaining. So remember, this was the profit. So this is the total. So what remain? We have these are the ratios. These are the ratios in which we are going to share this remaining profit. So the gross taxable is this. This is the amount which will be taxed to the partner, Dr. Justin. This is what is going to be taxed to Dr. Faith. And this should be equal to the profit. So remember, what we are sharing is the profit minus these expenses. These are the expenses that we are deducting are 300, 100, 260. That's what we are deducting. That is 660, and the remaining is 1035. This 1035, we are going to allocate it in this ratio. So 3/5 times this amount, 2/5 times this amount, then you get this amount should be, when you add this and this, this and this, it should give you the profit that was being shared before. Then we have the less interest on drawing. So you deduct this interest on drawing. This drawing are the one where, if for example, as a partner, you had injected a capital of 50,000, then you deduct 20. So that's 20. There is always an interest in that drawing to discourage partner from drawing capital. So these are the ones that we are deducting from partners' gross taxable income, and therefore we get a taxable income as this one here for each partner. So this is what the partners are going to be taxed by KRA. And this is normally taxed in a graduated scale like in other employees. So there is a class activity here. Please do it on your own. And if you find challenges, please let me know. Otherwise, thank you and have a good day.